Hey everyone, and welcome back to another episode of Heavy Yields, your go to channel for everything finance and fitness. Today, we're diving into the world of bonds, an essential financial instrument that you should know about if you're starting your investment journey or just want to learn more about finance in general. We'll cover what government and corporate bonds are, how they work, their characteristics, and more. But before we get started, please note that the information provided in this video is for educational purposes only and should not be considered as financial advice. Please always consult a finance professional before making any investment decisions. Having said that, let's jump in. To begin with, let's talk about what bonds actually are. Bonds are essentially IOUs or debt securities issued by governments or corporations. A debt security is a financial instrument that represents a borrower's obligation to repay a lender with interest over a specified period. So, when you buy a bond, you're lending money to the issuer, in this case, a government or a corporation, in exchange for interest payments and the return of your initial investment, called the principal, when the bond matures. Now, as I touched on, there are typically two types of bonds: government bonds and corporate bonds. Let's take a look at government bonds first. Now, as I live in Australia, I'll be focusing more specifically on Australian government bonds, but the same basic principles apply for all government bonds. Australian government bonds are issued by the Commonwealth Government to finance its budget and to support the Australian economy. They're considered relatively low risk investments because they're backed by the full faith and credit of the Australian government. In other words, they're backed by the government's ability to repay the debt via raising money from its citizens and the businesses that generate a profit in its country, i.e., taxes. Now, for a government to make money through taxes, that government must have a well-functioning economy where businesses and the average person are able and willing to pay their taxes. So, when you buy a government bond, you're essentially buying the belief that the government and the economy are stable and strong enough where it can keep generating enough tax revenue in the future for you to be paid back the money that you're owed. This is why they're considered relatively safe, because it's very unlikely and very uncommon for a government to default on its debt obligations, as it can usually raise more money by charging more taxes. This isn't always the case, however, and it's why some government bonds are considered more risky than others. For example, the return you earn on a US government bond or an Australian government bond is going to be less than what you earn on a Brazilian government bond or an Argentinian government bond, because these economies, the Brazilian and the Argentinian economy, are considered less stable and less strong than the US and the Australian economies. Now, there are different types of Australian bonds, such as treasury bonds, treasury indexed bonds, and exchange traded treasury bonds, which all have their own unique features and benefits. Now, let's touch on some corporate bonds. As opposed to government bonds, corporate bonds are issued by companies to raise capital for business expansion, research and development, or any other corporate initiative. These bonds generally offer higher interest rates compared to government bonds, reflecting the higher risk that's associated with investing in a company rather than investing in a government, which is essentially what you're doing by buying a government bond. Unlike government bonds, which are backed by the government, corporate bonds are backed by the company that issues them. This means that if the company goes bankrupt or fails to make its interest payments, you as an investor might lose your money. Now, this also applies to government bonds, but as I touched on previously, it is less likely that a government will default on its debt obligations, as it can raise money through taxes, whereas a company cannot. Now that we've discussed government and corporate bonds, it's important to touch on the characteristics of these bonds, the first of which being the maturity date. Now, the maturity date is the date at which the principal will be repaid to the bondholder. Bonds are issued with short, medium, or long-term maturity dates. Short being anything less than 1 year, medium is greater than 1 year but less than 10 years, and long is anything greater than 10 years. Second is the face value. This is the amount that you'll receive when the bond matures, also known as the principal. Third is the coupon rate. The coupon rate is the interest that the issuer agrees to pay you and is expressed as a percentage of the principal or the face value. Fourth is the coupon itself. The coupon is the amount of interest that the bond issuer will pay you for purchasing the bond, typically paid out on a semi-annual or an annual basis until the bond matures. Now think of this in the same way that you pay interest on a loan from the bank on your mortgage, but instead of paying the interest to the bank, you are receiving interest from the government or from the company that you bought the bond from. And last is the yield. The yield is the rate of return on a bond, which takes into account its purchase price, its face value, the coupon rate, and its time to maturity. Now that we've touched on bonds' characteristics, we'll discuss how they actually work. When you buy a bond, you're essentially lending money to the issuer. In return, the issuer promises to pay you regular interest, i.e., the coupon rate, until the bond reaches its maturity date. At maturity, you'll then receive your initial investment back, called the principal. Now, bond prices can fluctuate in the market, which affects their yield or their return. If a bond's price go up, its yield, i.e. its rate of return, goes down, and vice versa. All right, guys, there you have it. A beginner's guide to understanding government and corporate bonds. Now that we've covered the basics of bonds, in my next video, I'll be diving a little bit deeper and explaining some of the risks associated with bonds as they are impacted by interest rates and inflation, which we've covered in my previous videos. I hope you found this video helpful and informative. If you have any questions about bonds or anything else that's currently going on in the world of finance, feel free to leave a comment below or reach out to me on any of my social media channels. Once again, thank you for tuning in to another episode of Heavy Yields. Be sure to like the video, subscribe, give it a share, and turn on that notification bell so you don't miss my next episode. As always, thank you very much for tuning in. I hope you have a great day. Take care, legends.